Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. I'm back. It's been a while. I've had some personal issues, but now I am back with more videos that I'll try to do more regularly. Now I'm back with a new series of videos that are going to analyze dividend ETFs. Going to start with SCHD. In this series, I'm going to kind of go over portfolio construction, their dividend history and growth, their performance and valuation, and then give each one a made up scorecard based on factors that I find valuable that you might also find valuable. Like I said, this is going to be a regular thing. I'm going to try to do a variety of different ETFs. If you have any suggestions, let me know in the comments down below. Like the video, subscribe, etc. All of that good stuff, because these videos will keep coming. And we are starting with SCHD, the Schwab U.S. Dividend Equity ETF. This is a popular one. A lot of people invest in this one, so I wanted to see if it's actually a good one and see how this portfolio is constructed. I've created this Google Sheets that I'm going to keep updated with a lot of information. If you want to see more information on this Google Sheets, right now it's very simple. Again, let me know in the comments down below. Right now, ticker SCHD is trading at 73.79 as of 8/30/22, as of the morning of 8/30/22. This is about 10.5% below its 52-week high. I think the market's going to be up today, so that will probably trade a bit higher after today or during the day today, depending on what happens. It's a 3.29% yield based on the latest 12 months of dividends, a 5-year average yield of 2.9%, and we'll dive into some of the other stuff soon. So let us get started with this PowerPoint I created. Start from the beginning and scroll on down. Again, welcome to the analysis. So we'll talk about details, portfolio construction, dividend history and growth, performance and valuation, and scorecard. And again, disclosure on the bottom there. I am long this ETF and maybe long other stocks discussed in this article. This is not investment advice. I am not a financial advisor. Please talk to a financial professional before investing, as any investments come with risk of loss, sometimes permanent. This video is for entertainment purposes only. And to tell you that, hey, the name of this thing is should, and that's good, because you can say, what the hell is going on with this should when the market is down like it is today? So, jokes. Schwab Dividend Equity ETF. This ETF was started in 2011, so not a lot of data we're going to be working with. This was started after the 2008 recession, so you're going to miss that out. You will hit the 2020 market correction, the recent market correction. So there will be some times where this ETF has been tested. It'll be interesting to see how this has performed against the regular market, whether some of the benefits of dividend ETFs, like less volatility, carry through here. This is a passive strategy with a low expense ratio of 0.06%. The assets under management on this one, $39.3 billion. This is one of the biggest dividend ETFs, so probably there's a reason for that. And like I said before, the last 12 months of dividends on this one, you get $2.43, which is a current yield of 3.29%. And that compares favorably against the average yield that you could have gotten this in the past 5 years of 2.93%. So on average, it's a better deal today than it was in the past 5 years. There have been better times from a yield perspective to buy this one, especially in the doldrums of 2020. This is a combination of price appreciation, price depreciation, but also the dividend growth that comes with the type of dividend ETFs that you see here. So you may say, well, 5 years ago, I could have bought this at $45. What are you talking about? It's a better deal. Well, the price has appreciated, sure, but so have the dividends. So yeah, it's almost always a better deal to buy something 5 years ago in terms of cost basis. But dividends will appreciate since then, along with the price. So the yield you could have gotten back then was probably close to 3% as well, and you're getting a better yield today. So again, your yield on cost from 5 years ago is certainly better than the 3.9%, but that's what happens with a growing market. So just keep that in mind when you look at some of these comparisons on a go-forward basis. So how does this portfolio get constructed? Well, it is relatively passive, like I mentioned. It tracks the Dow Jones U.S. Dividend 100 Index, which is a index that was created right around when this ETF was created. So they were just like, oh, there's a new index created, let's just follow it. And in order to be included in this index, stocks must be part of a larger broad market index, which is about 2,600 companies, must not be a REIT. So this excludes REITs for tax efficiency regions. And the stocks must pass the following three screens. They must have a minimum of 10 consecutive years of dividend payments, a minimum float adjusted market cap of 500 million, and a minimum 3-month average daily traded value of 2 million. So basically this says, hey, we're avoiding some of the small cap names. We're avoiding names that don't trade readily on the market because we as an ETF are going to buy a ton of these stocks. So we want to make sure that they're easy to buy, that the buys we make don't adjust the price too much. So we're going with more medium to large cap names. And we also are focused on dividend payers. And we want to make sure that these companies have paid dividends for 10 consecutive years because that's important when it comes to constructing a dividend-based ETF. Now, since this was created in 2011, obviously these companies paid the dividends through the 2008-2009 recession/crisis. So that's a good thing, but it doesn't necessarily mean that they will also fare perfectly through a future recession. We are in a rather complex market right now. Is a recession ahead? Who really knows? These companies did fare well through the previous recession, but that is like picking the winners after the game has been played. Doesn't necessarily mean that they're going to fare equally well through the next recession, but it does bode well in the fact that they have already survived a recession, because even though the data here won't reflect that 2008 recession, this minimum of 10 years of consecutive dividend payments means that the companies did well during that time frame. So all told, this filter, this three-part filter, the most important part being that 10 years of consecutive dividend payments, takes the 2,600 companies down to a few hundred. I believe it's like 350, 400 companies. And these eligible securities are ranked based on another four characteristics. One being free cash flow to total debt. So that's the annual cash flow divided by total debt. And companies with no debt are ranked first. Two being return on equity, the annual net income divided by shareholders' equity. Three being the annual dividend yield, which is simple, the annual dividend payout divided by the share price. And four being the 5-year dividend growth rate. So let's imagine there's 300 companies. These companies are ranked each on each of these four characteristics. So for example, for annual dividend yield, the company that has the highest annual dividend yield will be ranked first in this hypothetical scenario of 300 companies and will get 300 points. The same ranking, the one that's ranked absolutely last will get 1 point. The same ranking is repeated for all of these other things in dividend yield, growth rate, equity, return on equity, and free cash flow to total debt. And then these four rankings are equal weighted to create a composite score, and the top 100 ranked based on that composite score are selected to the index. And for any ties, the stock with the highest dividend yield wins. So essentially they're saying, well, we feel like these are four important characteristics for a company that is a dividend payer and a dividend grower to have, and we're going to pick the 100 companies that have the best composite of these four characteristics. So again, a company might have a high annual dividend yield, but may not be growing their dividend at a fast clip, if at all, which means they might have a high score on the dividend side, but a low score on the growth side. And maybe because they have a high dividend yield, maybe they support that with debt and they have a low score on the free cash flow to total debt side, and maybe they fall out of that 100 ranking. So companies that are good at many of these characteristics are probably going to do better than companies that are good at just one of these characteristics. And basically you're saying, hey, we want companies that are free cash flowing, that don't have a ton of debt, that have a good return on equity, that pay a good dividend yield, but maybe not super, super high. And because of that, they're able to grow that dividend at a pretty decent clip. So this is an interesting way of approaching it. I feel like it's a pretty good way of approaching it. You've got these four things that I feel are pretty important. You may disagree, but again, dividend growth and annual dividend yield are certainly important in a dividend ETF. You want free cash flow that is not consumed by a lot of debt, because you want these companies to be able to handle a recession if one comes. If we are staring down the barrel of a recession, I understand why people enjoy dividend ETFs. They may not provide the best return all in all, but they are providing something on top of that in the form of income. And they also sometimes do better in a recession in terms of the amount of losses that they generate versus a growth fund or a standard S&P 500 fund. And the reason for that is, they are known to be safer. They are people feel like they're safer, and people kind of move into those funds, move into those stock names when bad times happen. That's why they do well. The kind of why value stocks sometimes do well, because dividends make you feel better. They sometimes make you feel warm inside, and that's sometimes enough for a stock fund to do better than one that doesn't pay dividends. Doesn't necessarily mean that dividends lead to better results, but if they help you get better results, then maybe that's enough. Sometimes people say, well, dividends are useless because they're just, giving you back your money and the stock price reduces by that same dividend. And yeah, that's true. They don't necessarily mean that, hey, a dividend payer will have better long-term returns, because data doesn't support that. But if you are able to make it through a recession without selling your ETF, because your ETF continues giving you 3 to 4% yield, and you're like, well, now I'm reinvesting that yield into lower prices, and that makes me feel good. And because of that, I'm not as afraid as I would be if I was just losing price without getting any sort of payback and reinvestment opportunities. And because of that, I would sell my stock at a bad time, or I would sell my ETF at a bad time. Then maybe dividend ETFs are worth it. And I totally believe in that. I totally believe that it helps the mentality of an investor. And I think that if it does help the mentality of an investor and it helps them stay steady during turbulent times, then they're totally worth it, even if the performance is slightly worse or equal. And in this scenario, the stuff that it filters out makes sense. So this scoring rubric is run annually. A buffer is added to prevent too many changes. A stock only has to be in the top 200 upon annual review to stay within the index. So again, they want to make sure that companies aren't in and out too often, because that's going to change the potentially the expense ratio. They want to keep it as passive as possible. And then once a stock falls out of the top 200, stocks are added in based on their ranking until the stock count reaches 100. And then stocks are weighted based on their capped free market cap. No stock can represent more than 4% of the index, and no industry can represent more than 25% of the index. So again, these are adjusted quarterly as needed. And there is also a daily weight check to make sure no individual stocks make up too much of the index. Some of stocks making up more than 4.7% of the index cannot exceed 22%. So a bit of complexity here. The idea is, hey, we want to make sure that one stock doesn't suddenly go up 400% and makes this thing too volatile and makes this thing too dependent on that stock. We want to make sure that no one stock can drive the performance up and down too much, because this is supposed to be a less volatile product. So we're capping it at 4%. We're capping it at 4.7%, and making sure that none of those 4.7% plus stocks exceed 22% when they're summed up. So if a couple of stocks suddenly explode, this thing would composite that at the quarterly adjustment to make sure that it doesn't make up more than 4% of the index. So that's kind of why those are there. Interesting construction, totally get why it's there. And all in all, this certainly creates a portfolio that's pretty familiar in terms of the names. As far as the sectors go, as of 6/30/22, information technology is the number one sector, which is interesting because that's one of the negatives that some people say about this ETF, and I'll talk about why that is. And that's based on the way the portfolio is constructed. Financials are number two, consumer staples followed, and healthcare, then industrials. Because of the way it's constructed, because of it avoiding stocks below a 500 million market cap. Most of these stocks are large cap in nature. You can kind of see 92% of the stocks are 15 billion or more. So this is going to be relatively similar to something like the S&P 500 in terms of performance, in terms of how it looks, in terms of the stocks that are in there. It's mostly large cap. There's a few no small cap stocks really, and some medium cap stocks in that 1 to 10 billion market cap space. So going back to information technology comment, that seems like it's tech focused because that's the number one sector, but really it does avoid some of those tech names that people want in their portfolios these days. Microsoft, Apple, etc. They're not here, and that's sometimes seen as a negative. But that's by definition how the portfolio is constructed, right? It avoids those companies that haven't paid dividends for 10 years and don't have a decent yield. And those companies don't have that, right? Microsoft only recently started paying dividends, same as Apple. They might not have that history of dividend payment. Their dividend yields are pretty low. So even if they do have 10 years of dividend payments when it comes to some of those larger cap tech companies, well, maybe they don't have the high ranking on the yield part of the thing, because this is not only a growth focused ETF, it's also a yield focused ETF. It kind of combines the best of both worlds in that regard. And when you look at the information technology names in the top 10 here, you've got Texas Instruments, which I think is a good company. I am long that company. But you've also got like, IBM, Broadcom, and Cisco. And some people say, hey, Cisco, IBM, kind of old school tech companies are, they were around in the 2000 bust. They were big companies then, and they haven't really done a ton since then. Are they really good companies? Do they want those to be in here in lieu of companies like Microsoft and Apple, which are the big names now? Well, maybe, maybe not. We'll see how the performance of this ETF shapes out to be. But in general, again, Cisco is an old company, but it continues being a dependable dividend payer. Same with IBM. It might not be growing as much, or it might even be shrinking in terms of price, which is never a good thing. But if all of those other criteria are still being met, then maybe in the long run, it'll be a good investment. Beyond that, you've got familiar names, like I said, PepsiCo, Home Depot, Coca-Cola, Merck, Amgen, Pfizer. I think if you look at a lot of dividend-based ETF, you'll see a lot of overlap, and we'll kind of talk about that more as we do other reviews. But just wanted to kind of point out the top names in this portfolio, and you can kind of see, well, where is this construction based on the criteria that we talked about? Where is it leading? And it's leading to, very large cap focus, relatively familiar names. These are just the top 10 holdings, but the top 10 holdings do make up almost 40% of the overall portfolio, and then you've got 90 other names in here that kind of make up the rest. So it is a relatively top heavy. And if you hate these names, if you look at this 40% of the portfolio and say this is terrible, then maybe this isn't the spot for you, because it is important to know what is in your portfolio when you invest in it, when it comes to ETFs and how it's constructed. So now that we've looked at that, let's look at the dividend history and growth. Well, the idea behind a dividend ETF is you want the dividends to be consistent and to go up even through turbulent times. And this is the type of graph you want to see. You want to see a graph that's up and to the right. And this is certainly up and to the right. And every year is higher and higher. And we have started here in 2013, the first full year of dividend payments, and going all the way through 2021. We are halfway through 2022 at this point in terms of dividend payouts. But growth still continues in terms of comparables between quarter one, quarter two, 21, and quarter one, quarter two, 23. But the graph here is good. The important thing is, hey, in 2020, we saw a bit of a turbulent time. The S&P 500 actually shrunk in dividends in 2020, reducing their dividends by about 5%. But in 2020, you went from a $1.72 payout to $2.02, and going forward into 2021, you saw further growth, which is really, really nice to see. You want a dividend ETF that's consistent and can handle a turbulent time like 2020, and it certainly did that pretty well. We'll look at it on a percentage basis. Where's the growth? Every year you saw at least 7% growth. You saw 17% growth in 2020, moving into 10.9% growth in 2021 off of a bigger base year. And that's great when you talk about something like the VOO, the S&P 500 ETF, which saw their dividend shrink by 5%. That is really impressive to see that type of growth during a year where a pandemic shut down a ton of businesses. You can see that these businesses have been resilient. And the overall dividend growth rate for SCHD since its first full year of dividends is 12%. Pretty solid. Again, we won't see how that compares until we do more ETF reviews on other dividend ETFs, but that is very good against something like the S&P 500, which has grown dividends at about 7% since then, and that includes that reduction in 2020. And that's important. When you have a dividend ETF, you want growth that eclipses something like the S&P 500, and probably should eclipse the S&P 500 because it's focused on dividends. You want yield that eclipses the S&P 500, which this does. You obviously want performance that is pretty close or maybe even eclipses the S&P 500, but even if it doesn't, you get other benefits like less volatility potentially. But you want dividends that are uninterrupted. You want dividend growth that continues through bad times. And again, we haven't seen anything long-term that was terrible yet. We haven't gone through a prolonged recession in terms of stocks. 2020 was certainly terrible in a lot of ways, but stocks only took a couple month dip and then started to recover. And even though the S&P 500 cut their dividends that year, this one didn't, and I actually grew it at a clip that was 20% plus above what the S&P 500 did since the S&P 500 shrunk. And overall, there's a 5% difference in terms of the S&P 500 growth rate and the SCHD dividend ETF growth rate. So that's really, really nice to see. Very important if you're a dividend ETF investor to be focused on this, and this does well in that regard. So let's look at performance. This is starting in January 2013, going through July 2022. The latest data is available, comparing the U.S. Dividend Equity ETF to the S&P 500 and the total stock market ETF. Wanted to see how it compares against those because we haven't done any other ETF reviews. We'll compare dividend ETFs to dividend ETFs once we have more of that data. This isn't necessarily the perfect comparable because a dividend ETF is focused on income, not necessarily focused on full total return, but you do want it to be close to something else that you can invest in, because after all, if you're not focused on income, you should be focused on overall performance. And over here, it does pretty well. It's a 13.7% return against 13.7% for the total stock market and 14.1% for the S&P 500, so slightly below that. The important thing is, hey, look at the worst year. The U.S. Dividend Equity ETF is down 6.3%, whereas the other two are down 13 and 14% respectively. The max drawdown, which is the highest peak to trough, the highest, the top to bottom that happened, it was actually higher on the Dividend Equity ETF SCHD than the S&P 500, and that happened during 2020. It happened January through March actually, for the SCHD. But for the S&P 500, it was actually this year, January through June of this year. And that was lower for the S&P 500, which may seem like an oddity. The good thing is that the SCHD ETF recovered really quickly, which is why its worst year is only negative 6%. And the S&P 500's worst year is negative 13%. So again, if you are looking for less volatility on a year-to-year basis, SCHD has been doing that. Long-term returns are slightly worse, but sometimes volatility is important. If you see something down 50% in a recession and something else is down 30%, maybe you're willing to give up, half a point or a point of returns for that steady hand. We haven't seen a recession here, but this is a good sign that it's down 6% versus 13%. The max drawdown is similar. To some, it may be concerning that the max drawdown of the equity ETF, the U.S. Dividend Equity ETF, is higher than the S&P 500. To me, it's not a huge deal because that's a short-term reduction in price. It was a shock event in terms of the pandemic. Something happened. It all basically happened within 1 month. It happened in March for the most part. And the SCHD ETF recovered by, I believe, August of that year. And it has done well this year versus the other ETFs and that are on the page here. It'll be interesting to see how it compares against other ETFs once we do more dividend reviews. But overall, this is very impressive. Again, you do have the income that is coming in for those dividend ETFs, and maybe that income is enough to make you not sell. When something drops 20%, but you're getting 3 to 4% in income, you may feel better about buying at lower prices. And as it recovers, if you didn't sell, you're better off that somebody else. You're better off than somebody else who sold when something dropped 20%, but they weren't getting any income, and that may be enough. If you're that type of investor who is going to panic when something drops a lot, maybe a dividend ETF might be for you. I do invest in dividend ETFs, even though I'm not income focused, because I do believe there is something to say about not having massive down years in terms of the mindset that it gives you. If you're not afraid of a terrible year coming up because you feel like you're going to do better in terms of holding on to that ETF because those dividends are being paid out, maybe that's worth it. Maybe that's worth giving up 1% in return, 2% in return, because at the end of the day, that return only exists if you hold on and don't sell at an opportune time. If you sell when something's down 20% and then it suddenly rises 30% and you miss that 30% run and you have to buy back after that happens, then these returns don't matter. These 13% annual returns are hypothetical if you hold through the ups and downs, right? If you are selling at the wrong time, buying at the wrong time, your overall return is not going to be 13%. That's why a lot of those studies that look at overall returns for individual investors and they say they're 3 to 4 to 5%. Well, that's because people panic when things look crappy And if you can avoid that panic because you're holding on a dividend ETF that's paying you 3 to 4% during those times, 5% when prices are down, and you're buying more because those dividends are being reinvested in lieu of selling because you're panicking because your ETF that doesn't pay dividends is down even more, and doesn't pay those dividends, and you don't feel as good about holding it and buying more, maybe that's worth it, right? Long-term returns only matter if you're a long-term investor. And if it helps you be a long-term investor, then it might be worth it, even if you're not getting the best returns. So we can look at annual returns over here, and this kind of shows you where some of that volatility comes in. SCHD is in blue. And you can see 2022, a good year to kind of look at. Well, we are seeing kind of a bear market. It's been a bit of a recovery, a bit of a downturn now that isn't captured in this data because it ends in July 2022. But you can look at the prices. SCHD has done relatively well. It's still down only 10% off its 52-week high, whereas the market is probably down a bit more. So you can see 2022, the S&P 500 down 12%, the total stock market down about 14%, and the SCHD down about 6%. And it's it's not perfectly correlated to something like the S&P 500. It's going to be somewhat correlated to the S&P 500 because a lot of these names are large cap names, but it might do better in a recession. That's kind of why you're buying something like this, a bit of a safety net. If a recession happens, if stocks drop 50%, in a year or in half a year, SCHD is still going to be down a ton. It's not going to prevent a price drop in terms of a recession. If the stock market is down 50%, this thing might be down 40%, or it might be even be down 50%, depending on what's being impacted. But in general, it should be down slightly less in a recession. It's still going to be down a ton. But if you are able to hold it, like I said, through a recession because those dividends are being paid, assuming that the dividend cuts don't come for the stocks in this ETF, then it might be worth it from a long-term perspective. So if we look at portfolio income, clearly this is why a lot of people come to dividend ETFs. If you are focused on income, still should be focused on total performance, but if income is important to you, if you're using some of this money to do whatever, to reinvest, to live off of, this is important to you. You can kind of see that in 2013, 2012. There's a slight difference in terms of the yield that you're getting from SCHD versus the other funds, maybe 20% difference. But then as you go towards 2021, because of the growth that you've seen here, you're basically doubling the income that you're getting from SCHD versus the other ETFs represented here, because growth is better, the income you're getting is better. Someone who bought in 2013, for example, yield on cost is basically the yield you're getting today versus the cost you paid whenever you bought it, right? So that's kind of what we talked about earlier. If you bought in 2013, you were paying a 3% yield at the time, but dividends have grown since then, and based on the dividends that are being paid out today, you could have bought a share of SCHD at $30 in 2013, which at the time was a 3% yield based on the dividends that were paid out then, which was about 90 cents. And now you're in 2021, you still have that share you bought at $30, but your dividends now are $2.43 in the last 12 months, which is about an 8% yield. So your yield on cost on 2013 purchases is 8%. Your yield you're buying at today is 3.3%. But as long as dividends keep growing, if you buy today, your yield on cost, 7-8 years from now could also be 8%. This is all ifs and buts depending on what happens, but that's the idea behind dividend ETFs. You're buying today because dividend growth will occur. Your yield today might only be 3%, but as that growth happens, the dividends you get year on from now will be higher, and your yield on cost will be higher. So that's kind of the beauty of dividend ETFs and dividends in general, and why people like them, right? And we kind of talked about, valuation. The dividend yield today is 3.29%. And you can kind of look at, what's the average yield that you've been buying this as an investor in the last couple of years, almost a decade here? It's rarely been above what it is today. Yeah, the max yield has kind of reached that point. Even this year, you could have gotten it at 3.43%. Last year, you couldn't have gotten it at a better yield than you have today. But in 2020, the max yield you could have gotten was 4.37%. That was a great time to buy. So in general, whenever this stock is yielding above 3.2%, which it is now, it's a pretty good time to buy. You can kind of look at the price and say, it's only 10% off its 52-week high. It could drop lower. Yeah, it could drop lower. That could always happen. But on average, it really hasn't. There's only been 2 years where the max yield has been above 3.27%, 3.29%, and that's 2020 and this year. So yeah, it could potentially drop lower. Do I believe it will drop lower? I personally do. You might not, but there's volatility in the market right now, and it's going to impact everything, including ETFs like this. But in general, this is a pretty good time to buy, and in the long run, it will work out at a price point like this because you're getting a decent yield. The estimated EPS for the investments within these ETF is about 4.98, which at this time is about a 14.9 price to earnings ratio, which compares favorably against 20x-ish to the S&P 500. And again, some of these names are more of those value names, which is why the price to earnings ratio is lower. Now, a PE of 15 seems great, but if there is a recession, the E part of the equation will get cut in half, so the PE will suddenly drop quite a bit and the prices will drop quite a bit. And if dividends are cut, then the yield could also suffer. We're also in a period of time where we have been in a period of easy money and low treasury yields. So that kept some of these valuations down. Obviously a 2.9% average yield before 2019 looked pretty good when treasury yields were basically close to zero. But now that treasury yields are getting to 3-4%, more comparable to what this is yielding, this looks slightly less appealing in comparison to that, especially if you can get, let's say you only have $10,000, maybe you're better off putting it into I bonds for this year because those are yielding 9% than SCHD, which is only yielding 3.3%. Now, remember, a treasury bond or something like that will be, if you buy a treasury bond for 2 years, that's at 3.5%. That's never going to grow that yield, right? Those payments are locked in. Same for a 10-year bond, that's maybe 3.9% or whatever it is these days. Dividend growth will occur off of your 3.2% yield. So in the long run, your yield on cost should be higher. People are always going to be worried about buying things going into a recession, but far more money has always been lost waiting for the market to crash than actually buying when the market crashes. I do have more cash on the side than usual, but whenever this kind of hits that 3.3, 3.4% yield, I do buy a little bit of SCHD because I think it's a good long-term investment and it's proven that. Certainly market dynamics are what they are, but from a historical perspective, a 3.3% yield is a pretty good one. It's better on average than almost every year except for 2020. If this thing starts hitting, if there's a little bit of a market recession and this thing starts hitting kind of what we saw in 2020, where the payouts were in that 4% plus range, I think this will be a really, really good spot to buy this at. Might not ever happen. Who knows? Can't predict the future. But today's prices are certainly not bad in terms of the historical valuation that this has seen. So that all comes down to the scorecard that I've kind of made up based on nothing in particular. And these scores will probably change as I do more dividend ETF analyses, simply because there's no comparable right now, right? The dividend yield is kind of based on what this is, but there's going to be other ETFs I review that have better yield, that have better growth, that potentially have better performance, that potentially are a better valuation, that have been around longer. So this scorecard will change. But in general, a cost structure, it's below 0.1%, very good for an ETF. That's a 10 to me. Dividend yield at 3.2%. Again, this is not a high dividend yield fund. There are funds that generate 5-6% plus. So I kind of gave it a 7. Seems like it's kind of right in the middle. It's not amazing, but it's certainly not terrible. Dividend growth, really solid. Anything over 10% to me, anything that eclipses the S&P 500 by 5% or so is great. I gave it a 9. Might see some dividend funds that grow much faster, which may reduce it in the future, but pretty damn solid. Performance, I would say, is solid, really, really good. Again, the S&P 500 did beat it, so couldn't give it something like a 9 or a 10, which I think would be reserved for ETF funds that beat the S&P 500. But I doubt I'll find that many. So in terms of ETFs, this might be the best of breed. So maybe the score is a bit too low. We'll see once I do more of these reviews. And then valuation, we just talked about it a second ago, a 3.29%, really solid in terms of historical yields that you can get on something like this. Could get better, could get into the 4% like it did in 2020, but that was, kind of a shock price hit. If you were buying then, you're probably really happy today because you got a really good yield on cost already because you've seen some dividend growth since then. And then your price appreciation has also happened. You were probably buying around $50 since then, around then, and now it's back into the 70s. So if it ever gets into the 50s again, I will be scooping this up hand over fist. But the valuation today is pretty darn solid. And then longevity, again, only started in 2011. Did miss that 2008 crisis. It'll be interesting to see what happens in the next recession. We are probably due for a recession. Honestly, we might already be in one. We just don't know about it. The Fed is going to keep raising rates. That is going to impact some of these dividend ETFs negatively because, like I said, those are the valuations of dividend ETFs, and dividend payers sometimes go hand in hand with 10-year treasury yields. If you're getting 3% here, even though it's growing, and then suddenly the 10-year yield is giving you 6%, 7% because that's where the yields are going. That's where the Fed is raising rates. That's where inflation is heading. Maybe this 3% is not enough. Maybe the 7% suddenly looks a lot more appealing, and people will start selling this off to bring that yield to more of an equilibrium against those treasury yields. So overall, a really good fund. Again, not investment advice, but I am personally a holder of SCHD. Please do your own due diligence and all of that good stuff. Let me know if you guys enjoyed this. Let me know if you would like to see any specific dividend ETFs. If you go to the dividend analysis spreadsheet, Google spreadsheet that I'll share in the description down below, you can already see that DGRO, DGRO is next in line. That's a dividend growth ETF. We'll see how that one fares. And if you want to read more about this, see some of these graphs, some of this stuff is on my blog at timeinthemarket.com. So check it out there. You'll likely see the dividend analysis there first in written form before I make a video about it. So hopefully you guys enjoyed this. Hopefully you guys enjoyed this new series. Leave a thumbs up, a comment down below. Subscribe to the channel for notifications when more videos come up. But thank you for all of this. Thank you for watching, and hope you guys have a good rest of your day. And let me know what you guys think about SCHD. I know this is a favorite in a lot of dividend communities, so I can see why now. This is a really good fund. Performance is really solid. Dividend growth is really solid. A best of both worlds type of dividend ETF where yield is pretty good and growth is pretty good. So it's a rarity to see, but it's good to find it when you do see it. So hopefully this gave you some more info about this dividend if you're somewhat familiar, dividend ETF if you're somewhat familiar with it, and if you're not, gave you a good introduction to it. So thanks for watching and have a good rest of your day.